Hi everyone. Today, I want to show you why the market is totally irrational in the short term, especially during the earnings season. We'll look at recent declines in software companies in my portfolio, specifically analyzing Salesforce, ServiceNow, and Veeva Systems. Let's dive in. So, the month of May just ended, and despite the S&P 500 gaining 4.8%, some of my stocks have seen double-digit declines after their quarterly results. Mainly, we're talking about software companies. The entire technology sector was the worst performer in the last week of May. Let's start with Salesforce. As you can see, after releasing quarterly results on May 30th, Salesforce's stock dropped almost 20% in a single session. Headlines claimed it was the worst day for the stock since 2004. A non-expert might think the results were catastrophic, so let's look at the actual numbers. You can check the details yourself on the company's official website under Investor Relations. Here are the key figures. Revenue came in at $9.13 billion, slightly below the $9.17 billion expected. Just a 1% deviation, which any entrepreneur will tell you is practically irrelevant. What the headlines missed is that this revenue is up 11% from last year, clearly positive for us as investors. Now, let's talk about profits. Earnings per share, EPS, were $2.44, above expectations of $2.38, and up 690% from last year. Great data here. Finally, let's look at free cash flow. Free cash flow was $6.08 billion, up 43% from last year. These are not negative results. In fact, they're very positive. So why did the stock drop? The company's guidance was softer than expected, predicting EPS between $2.34 and $2.36 and revenue between $9.20 and $9.25 billion for the next quarter. This guidance is just 1.3% below analysts' expectations. Still positive forecasts, which, if met, mean a 7% increase from last year. So why the big drop? The market includes many speculators and traders who profit from short-term movements. Stocks like Salesforce fluctuate based on these trades, not fundamentals. Looking at a longer-term graph, these fluctuations are common. The stock has just retested its long-term moving averages, something it did recently in October 2023. Volatility is intrinsic to the stock market and should not concern long-term investors like us. Short-term oscillations, especially around earnings season, are normal and often present buying opportunities. Ignore short-term fluctuations. They don't reflect company fundamentals. Salesforce's fundamentals are excellent, with rising revenue, EBITDA, and free cash flow. Salesforce has a 68% gross margin and a solid balance sheet with minimal debt. For fiscal year 2025, they expect revenue to grow by at least 8% and EPS to be just under $10, above market estimates. As long-term shareholders, we should focus on the company's evolution over the long term. Even if there are short periods of stagnation or decline, the overall trend is upward for quality companies. I'm confident Salesforce will rebound, and its decline triggered similar drops in other software stocks with positive quarters, like ServiceNow and Veeva Systems. ServiceNow reported $2.6 billion in revenue, $10 million above expectations, and a 23% increase from last year. EPS were $3.41, up 43% from last year. Despite an excellent quarter, ServiceNow's stock fell 7% due to Salesforce's decline. This is sector rotation in action. Veeva Systems also had a strong quarter with $650 million in revenue, up 24%, and EPS of $1.50, up 83%. Yet, the stock fell 12% because its guidance was 1% below estimates. Again, this decline was due to speculative movements, not fundamentals. Veeva's fundamentals remain strong with rising revenue and cash flow. So, what I've shown is how short-term market movements are irrational and driven by traders, not company fundamentals. Focus on the long-term trends and the growth of earnings per share. I hope you found this analysis helpful. See you in the next video.